Hello, my name is Jeff Livingston. I am CEO of EdSolutions and co-founder of the Center for Education Market Dynamics. That means that I get to spend my professional life at the intersection of for-profit and not-for-profit education, helping both sides to find impact working with the markets instead of against them. I'm also proud to be a co-founder of Innovation for Equity, which is the organization that brings us here today. I have the wonderful privilege of being in conversation today with two other co-founders of Innovation for Equity, whom I also consider to be good friends. I will work hard not to make reference to how long we have known each other, because at least one of us is looking so young today that the truth would be unbelievable anyway. And Phil, Alphonse, since you are looking so young today, why don't you introduce yourself? Phil, why don't you introduce yourself so that our audience knows who you are and what you do? And in that introduction, I'd like you also to tell us what you were doing professionally 10 years ago in July of 2011, I guess it was, 10 years ago.
Okay, so I'll do the introduction first. I'm a senior partner at the Vistria Group. We're a private equity fund. Today we manage over $6 billion in capital. 40% of our capital is going to be focused on investing in education. I co-lead the education practice. So we have a number of assets in K-12, post-secondary, workforce development, and we're also an impact fund. So for us, it's important that we track some of the metrics that may not be as obvious on a P&L and balance sheet. And we have a number of operating partners and strategics that we work with to help us gain additional insight and help drive performance for our portfolio companies, and also help us on our initiatives around impact.
That's great. And July of 2011, what were you doing?
So I've been, you're talking work-wise. I mean, I've been investing in the space for some time, and I was investing in education companies in the summer of 2011. And I'm trying to think about what I was wrestling with at that time. I was on the board of a post-secondary graduate school business that I was working on a refinancing for. But I've been doing this for a while, and I've been investing in education well through that window. You may have to go back to 2002 or something to catch me doing something else.
Well, I knew the answer to that question. I was just giving you an opportunity to say how long you have been doing this.
Yep.
Maia Sharpley, since we all know you were in high school in 2011, why don't you introduce
middle school? Middle school. Get it right.
Why don't you tell us who you are, what you're doing today, so we can lead into this conversation.
So we'll start with 2011. I was just finishing up my math test for middle school. No, so in 2011, actually, I was living in Hong Kong, and I had just launched Kaplan's online business for higher ed, and we had launched it in Hong Kong and Singapore. And so blank sheet of paper to butts and seats, I was running that, racing around Asia, building out the business and expanding it. So I come to this from an operating side. I've been building and running businesses for years, all around the world, across all the different subsectors of education. And most recently, about 3.5 years ago, as I say, I switched to the dark side. And I started as a partner at Learn Capital in Silicon Valley, and investing in that. And Learn has an amazing team, amazing portfolio, both domestically and internationally. And most recently, along with another co-founder of IFE, so that IFE effect is in effect. So Dre and I started Juvo Ventures, which is a venture capital firm that our thesis, we believe that education opens doors, and it's that bridge to opportunity. And so we look for companies at an early stage, series A, B, pre-K to gray, both domestic and international, that are building that bridge to opportunity for folks.
That's great. So Maia, you mentioned that at Juvo, you all do early stage investing.
Yeah.
And Phil, you described Vistria as a private equity firm, which implies that you buy fully developed businesses and make them better. I wonder if we could spend a moment talking about the difference between early stage and later stage investing and how they might be interacting with each other a lot these days. And the lines are not as clear as they have been.
Absolutely. Phil, I'll kick off with early and transition to you for later, if that works. Great. So, I mean, when I first got into this and I started sliding to the dark side, as I said, I was running Kaplan's EdTech Accelerator in partnership with Techstars. So the very first pure play EdTech Accelerator. Jeff, I believe you were a mentor in that program as well. And, at that point, seed investing and pre-seed and all that was really like a $50,000 check for an idea. When we look at early stage now and where it is, you see companies that are at that seed stage raising, raising $4 to $5 million with very little revenue, which means that your Series A, which is where we start and where we pick up, has been increasing as well. So not the value, the amount, the revenues that are coming in, the amount that's being invested, and more importantly, the valuations are insane. Like pre-COVID, we would look at valuations at 4 to 6x revenues. Post-COVID, we're seeing 10 to 20x revenues. And we're also seeing in the early, across the board.
For early stage, you're saying.
Early stage for Series A, B. And, what we're also seeing, though, that this valuation is driven by folks like in Phil's category, as you have the later stage investors and generalists coming into the space that was traditionally occupied by early stage investors. And Phil, I'll flip it over to you to talk about that phenomenon that I'm seeing at the early stage.
Phil, Maia says it's your fault that the valuations are so high. Can you explain how that happens from?
Yeah, it's not my fault specifically. I mean, we try to stay in a very specific lane, and I'd say one of the biggest distinctions between buyout, and we're specifically buyout. So you do have different categories within private equity that's separate from venture, but we're typically investing in companies that are cash flow positive. We use a lot of different tools to generate the types of returns that our investors pay us to generate. And for how we invest, it's much better for us to have companies that are cash flow positive. And so for us, our lane is that we're typically looking for companies that are generating north of 10 million of EBITDA. So we think of kind of 10 to 50 million of EBITDA as sort of the sweet spot for our firm. And I think that's a key difference. We also tend to not take tech risk, or what one may think of as enterprise risk, right? Where we're really not in the business of starting something from scratch or taking risk in terms of where the overall industry is going. To Maia's point, there is a little bit of convergence, right, between the two worlds. What we're seeing is a number of traditional tech-focused funds that have historically not been traditional education investors getting into the education market. And I think that's really where you get a lot of the, I don't want to say it's gray area, but the traditional growth and later stage VC tech investors are very comfortable kind of straddling both worlds. And they're very comfortable paying some of the multiples on a revenue on a top line revenue basis. We're typically buyers on an EBITDA, sort of bottom line earnings or cash flow. Whereas software buyers tend to be a little bit more comfortable buying either as a multiple of revenue or some kind of multiple of recurring SaaS revenue. And what we're seeing is those types of buyers squarely jumping into the larger later stage business, and they are comfortable paying big multiples that aren't based on sort of historical buyout metrics. So it's not us specifically, but it's folks who who may look like us, but are traditional tech investors that are jumping into the game.
And another thing we're also seeing, I know it's not you specifically, but we're also seeing, I say that we're seeing later stage folks coming into the early stage. I'm also seeing early stage players, traditional early stage players growing into later stage. So we're seeing pure play ed techs who operated at that early stage of investing now spinning up funds to go into later stage investing, whether it's an opportunity fund or SPACs. There are several, ed tech focused SPACs that are a couple that are established by later stage folks, but we also have a couple of early stage investors, Michael Moe, Learn, who are spinning up SPACs to get into that later stage. So the lines are blurring in both ways.
So because we are limited in our time today, I'm going to let the audience Google SPAC if they don't know what that is, and we won't talk about it. But
Okay.
I want to take the conversation in a slightly different direction. I'm privileged to spend a lot of my time with very early stage entrepreneurs, a lot of whom are Black or Latino. And their interaction with the financing of such ventures is not often fun. Phil, you said it's not you, but folks who look like you. In some ways, those other folks don't look like Vistria at all, who are doing this. So for the entrepreneurs who are Black or Latino listening to us, and they want to know how to get the attention of Maia Sharpley at Juvo for their early venture, or how to get the attention of Phil, Alphonse, at Vistria when they are thinking about exit, what advice would you offer to those people who might be watching right this minute? What are you looking for when you're about to write a check, Maia?
So I look at standard things, I think like everyone does, but the first and foremost is the team and the idea and the product that they're building. And I'd rather have a very strong team with not a mediocre product, but a product that's unproven than the other way around. Because if there's a glitch, I know that team can carry it through. And so when I look at founders, and obviously the area that they're in, that there's a TAM and it can grow and all these things, right? I think another, math curriculum play in K-12 is probably not exactly where we're going, right? There are other areas that are a little more, where you can be more innovative. But back to that team question and to your question, right? When I look at founders, I think that, myself having faced some of the challenges, because I started out on the other side, building and running, and now I'm flipping over into the investing side. But, as an African-American woman, I understand, and I perhaps listen differently, as does my partner, Dre. We may listen differently to what people are saying. And while, founders may not hit all the key points that Silicon Valley wants to hear, what I like to think is that, I'll ask the extra questions to draw out the answers. And I also like all of my sessions to be kind of mentoring. So if I didn't hear the metrics that I needed to, I'd rather ask the questions and draw them out. And I hope the founders will then learn, okay, next time we should say this right off the bat, right? So it's a two-way street when Dre and I are listening to, and that's exciting to me because it opens the door to so many more founders with great ideas that otherwise might not have access. So, please come look us, seek us out, find us. We would love to hear your ideas.
And Phil, we see that you're having some technology problems here. So we're glad that you can be here. How do people get on your radar screen? If they are running an education company that has been around for a while, that maybe has peeked over into the revenue generation and EBITDA realm that you talked about, then what? How do they get on your radar screen at Vistria?
Yeah, I mean, we spend a tremendous amount of time looking for the themes, right? So I'd say we absolutely value management teams and operators. When we tend to light up when we come across folks that are that have experience in the areas that we're actively investing in thematically. For us, it starts with a deep dive on the verticals or the sub verticals that we want to invest in within K-12, within post-secondary workforce. We actually tend to do fairly comprehensive landscapes to figure out which companies we want to call on. And we get very excited when we come across, seasoned operators that are in those verticals, that know those spaces, that want to work with us. A big part of our model is aligning with thoughtful operators, and they don't need to be specifically folks that have prior P&L experience, but I'd say that in our world, that's a pretty big deal. So if you actually run a division, you've got good P&L experience, if you've worked with other private equity funds or you've had a prior successful exit, those are the boxes that, that people tend to look for. That makes us excited, but we tend to look a little bit more broad as well, right? So if you have a policy background, and you have a lot of good insights around, we own an asset in the special ed space, and if we're looking for folks who are thoughtful, that can help us think through how to approach specific market segments, and you've got experience around either a specific region or experience around special ed in that case, those, we tend to want to have, longer conversations and build a relationship. At the end of the day, the quality of the asset is sort of the big driver for us. So we need to make sure that, again, we're sort of in that lane in terms of size of asset. Once we find that, if we can married up with a thoughtful operator, that's where we see a lot of the magic.
That's great. For this, what is probably the last third of our conversation here, I'd like to take us to a bit of a forward-looking kind of a stance. It occurs to me that I'm going to actually be physically in a room with both of you within the next few weeks. And I haven't been in a room with either of you in more than a year and a half, despite the several years before that, seeing both of you several times a year doing that. And obviously I'm making reference to COVID and the shutdown of travel and the digitization of everybody's life, whether they wanted it to be or not, and those kinds of impacts. It seems to me that in the education space, a lot is happening as a result of that, not the least of which is the biggest increase in funding for education in any of our lifetimes via the ESSER and the American Recovery Plan that the Biden administration has put through. Somewhere between $100 and $200 billion of extra spending that's likely to show up in education, both K-12 and post-secondary. What are you two, as active investors in the market, seeing as the impact of that money and the broader impact of COVID on this space we all live in? Phil, let's start with you this time.
Yeah, and so the obvious answer when you've got 125 plus $1 billion coming into the market specifically for K-12, that clearly creates opportunity. So we see the tailwind. I think a lot of people have seen the tailwind. You couple that with the fact that 100% of the market has been using some form of online right over the past year plus, right, where it creates a foundation for use cases, particularly for curriculum content providers. It creates a platform for use cases that may not have been in place prior to COVID. And it creates a foundation for users that may not have existed in the past. So clearly all that means real opportunity. And I think you're seeing it in the multiples in terms of where stuff is traded. You kind of throw in the fact, what we mentioned at the top of the call, kind of new entrants in the ed tech space, and the amount of capital that's flowing in. It's sort of brewing a perfect storm. So clearly clearly a lot of tailwinds and a lot of interest kind of all around, sort of from all sides. When I look at it, when I talk to the CEOs in our portfolio, I would like to make sure that we're careful about being partners with our school, particularly our K-12 school customers, because this is a kind of a seminal moment where you can think, go for kind of the short money play and not be thoughtful about how your customers are using the funds, and whether or not it's a fit for what you're selling, or you can become a real partner for the districts. So we are spending some time talking to our CEOs, working through how we can be a little bit more thoughtful and not just grab at the money, but help our particularly for K-12, help our K-12 customers, hopefully be a little bit more thoughtful on how they deploy the capital. So to us, it's not just a tailwind, but it's an opportunity to really build a relationship for the long term. And if that means that we're not necessarily selling product, then so be it. But I think it's a very good opportunity to build a longer term relationship with the school districts if you do it the right way.
Right. How about you, Maia? How do you think this is going to impact the early days of Juvo's investments and the success of your portfolio?
Yeah, so I believe that education already had tailwinds going into COVID. So we were already seeing the acceleration of digital penetration in the education spending space, right? Going from 1% to 3% from 2008 to 2019. And we anticipated it would go up to maybe 10% by 2030. To compare those numbers, from 3 to 10% in retail, which is a larger industry, but that 3 to 10% penetration from 2008 to 2019 birthed companies such as eBay and Amazon and all of your e-commerce companies, right? Main Street fell, these companies arose. So if you kind of shift that into education, we saw these tailwinds coming in 2019. The shutdown and the lockdown and COVID simply accelerated that. So now that, we were thinking coming out of 2020, digital penetration could be that 10%, 3 to 10% number in 5 years, not in 10 years, right? And so we've been very excited. And that was part of kind of the rationale that Dre and I had in terms of let's jump out and launch a company where we can find these great entrepreneurs who are going to drive this change and help them do that. So we've been super bullish on this. To your point, now this funding, it simply just adds fuel onto an already lit fire. And so we're even more bullish about the opportunities for entrepreneurs and to actually change the landscape, to really fundamentally change the landscape. But I think the caveat that Phil gives it cannot be overstated, and it's all about execution, right? It's absolutely about execution. It's about being smart about the money, about making sure that you're not just doing a quick land grab and in 2 or 3 or 4 years, you actually don't have outcomes or results to show for it. And therefore you're at risk. So, you can ride the wave up, but if you don't actually have outcomes and buy-in from your learners or your customers, you can ride the wave back down equally as quickly, if not faster. So execution is execution and value, right? Really understanding what is the value, what are the outputs and the outcomes that we're looking at. Outputs and outcomes meaning not only financial, but also those impact values, because we are a double bottom line. How are you actually making an impact for the end user, whether that's a teacher or a professor or the actual learner in the classroom or an adult being upskilled, reskilled, or a corporation, signing on to actually help skill their employees. Whomever that is, we want to make sure that execution is key.
So I know for sure that this conversation could last all day because it has more than once, but I would like to close by giving you each the opportunity to tell our audience about one company, either in your portfolio now or in the past, that you're proud of, that you're expecting good things of in the future. Just one today, because I know you both could do that a whole bunch. So I'm going to ask you which of your children is the prettiest. And I'll start while you're thinking by drawing attention to a company I love and have the privilege of being a board member and investor of called All Here. which started out life as a company that was directed at attendance in public school systems, run by an amazing entrepreneur, an African-American woman named Joanna Smith. And during COVID, it turned out that her connection around truancy and around attendance was often the best connection that school districts had with some students. And through that connection, she has been able to give a better experience to a lot of students than they might otherwise have had. And the market is rewarding her for that now. And All Here is a company I want to draw attention to. So Maia, which of your portfolio companies is the one?
I love all of my children equally, Jeff. All of my children are wonderful in all many different ways. So I really do think we have an amazing portfolio, you know, having a hand in and being able to pick, and I really do. I guess one company that I've been working with for, I'd say almost over 3 years now, is OnRamp, which is founded by an African-American woman, Letitia Thomas. And what she and her team are focused on, and it's an all, the entire leadership team are from underrepresented groups, race, ethnicity, gender. And so really exciting example. But in addition to that, or actually almost in a way more importantly than that, what they're building is they are actually building pathways. It's an apprenticeship program, and they build pathways for underserved populations to gain great jobs in corporations such as Pandora and Twitch and Twilio and other, you know, top companies that are usually locked out, inaccessible. And I think the brilliance of what she's doing, you know, you hear about boot camps and you hear about this and that and the other, but Letitia and her team are actually working directly with the corporations to say, okay, we need to teach these coding programs like languages, but how do you use it in your company versus just pulling it off the shelf? And so with that approach, they not only are really serving and adding value to the corporation, because they're actually getting trained people who understand how they do it in Twilio versus Twitch versus Pandora, but the students who are coming through, the learners who are coming through, have that opportunity to apprentice with someone in the company. So she has an 100% conversion rate and incredible retention rates of people actually landing and getting jobs in high-paid jobs that were previously, you know, 4 or 6 months prior, completely inaccessible to them. And so that's a great example of impact at scale. I mean, she's still, you know, still very early stage, but where you can see impact at scale already for underserved populations. So
also another example of an entrepreneur, Letitia Thomas, is a force of nature. And I'm glad that she has the support of Juvo in doing what she's doing. All right, Phil, how about you?
Okay, well, you put me in an awkward situation to try and pick. So Jeff, I could mention one of our companies, a company called Penn Foster, that I think has the potential to be the leading provider platform in workforce training. They train 150,000 students a year. He's done a great job of bridging into you know, the B2B market and providing important training through channels with the Job Corps and staffing companies and the like. But I'm not going to mention Penn Foster. I could mention Academic Partnerships, that does a phenomenal job of supporting universities with an online program management solution, right? For high value degree programs such as nursing. They've got a great foundation, but I'm not going to mention them. I could mention one of our companies that specializes in serving kids with special needs, right? Where we do one-to-one intervention. We serve over 100,000 kids. We employ over 5,000 caregivers. They've done a phenomenal job through COVID and have proven the ability to serve families remotely, and are now back in the classroom, and they've done phenomenal work. But I'm not gonna mention them. The one I will mention is and it's because it's the most recent. the one I will mention because it's the most recent is a company called Edmentum, which serves over 5 million kids annually. We're in 35,000 schools, a real scale platform in the assessment and in the virtual school market. Jamie Candy is doing a phenomenal job as the CEO there. We're happy to partner with her. The outcomes that she's delivering through COVID, and now that we're emerging out of COVID, are off the charts. The reason I mention them is not just because of the quality of the platform and the programs, but we recently merged and we acquired another business called Apex Learning, which gives the company a tremendous amount of position in the virtual school market. And Jamie is one of the folks that we're talking to about how do we build a more thoughtful relationship with the school districts that we serve. She has a very strong sense around the balance between the dollar and the mission, and we expect a lot from the combination from Edmentum and Apex. So that's the one that I would throw out there.
I also know the companies you didn't mention and the one that you did mention. And I understand why you're proud of all of them, including even Apex, a company I've known for 25 years. But it's obvious that you all see a lot of opportunity in the next couple of years, that you're very actively involved in the education space as investors and in the mission of Innovation for Equity, which is to improve outcomes for Black learners from pre-K through college and workforce. And I'm glad that we've had this time to chat today. I'm also glad that I'll see both of you in San Diego at ASU GSV. And some of our listeners will come up to you in person and remember this conversation and maybe end up as the favorites in your portfolio the next time we talk. Thank you, Maia. Thank you, Phil, for this conversation. Can't wait to see both of you real soon.
Thanks, Jeff. Good to see you.
Thank you. Thanks, guys. Take care. Thanks, Jeff.
Bye.